What do you make of this reaction in the markets right now, at least in the futures right now? So maybe it's kind of like a jinx situation, but just yesterday, the president mentioned that the market seems to be adjusting to the tariffs pretty well. We were hitting new highs. This morning, a big reaction.
Yeah, I would say the market's somewhat confused here. So the tariff headline's been brushed off, as you mentioned, but the Canada tariff is pretty significant, one of our major trading partners. So this one could be for real, is what the market is suggesting. And that's why we're seeing some of the futures action that you're mentioning.
All right, with that, why don't we get to your word of the day? What is your word of the day, and what picture do you think it paints?
Yeah, I mean, my word of the day is confused. Beneath the surface of the market in this rally we've had for the last few days, there's a lot of turmoil. While we've seen this melt up slightly in the overall stock market, we've also seen below the surface a number of negative indicators. Some of the momentum names have definitely shifted lower. Value has been much stronger than growth, and trading volumes have been significantly lower, about 15 to 20% lower over the last few days than they've been over the last few weeks. So there definitely are some pain is being experienced by hedge funds in the market right now.
You know, we've been talking on this show quite a bit about this market being priced to perfection. These new tariff threats, again, against Canada and also the EU, is that something that you think may make investors more concerned about high valuations, about the market being stretched? We earlier this week reported that all the major indices had an RSI above 70, signaling overbought. Are these things that you think are now at top of mind for big investors?
They're definitely top of mind. It's really interesting to see that the VIX is at low levels, despite the fact that the uncertainty index out there is so high. So you have this dynamic where investors are grappling with these tariffs and saying, are they going to be for real, or is Trump going to chicken out? And until we get an answer to that question, we're going to see some volatility in the market. In my view, we'll likely see that VIX move higher.
All right, so you're expecting the VIX to move higher. Again, these tariffs are kind of shaking up investors, at least in the futures. We haven't seen it on the VIX. With that, I'm going to get to your pick. With this potential for volatility, why do you think Microsoft is the right stock to buy right now?
And Microsoft is one of the leaders in the AI revolution. We think that they're so well positioned to capture share going forward because they own the enterprise. Almost all companies use Microsoft's services. The enterprise cloud is really where it's at. And 70% of Microsoft's clients are likely to convert to the cloud, leveraging their AI. So we think Microsoft is the name to own in the AI revolution, along with NVIDIA.
Also, along with NVIDIA. Earlier today, we were talking about AMD and the fact that analyst significantly raised their price target on AMD, doubling it from 100 to 200, on the idea that their AI revenues are going to be better than expected as we continue to see this AI spending. Right now, again, with the volatility from tariffs, what other sectors or areas of that trade do you see benefiting?
Yeah, from a tariff perspective, we continue to see opportunity in big tech. Beyond big tech, we also like areas of the market that are a little bit less appreciated, including the home builders and including the REITs. And why I mention those is because we're also expecting long-term interest rates to come down. And this is a bit of a non-consensus call. Clearly, the futures price the Fed lowering rates materially over the next year or so, but there's a question mark as to whether or not long-term rates will also fall. In our view, we think they will. And that will benefit rate-sensitive sectors such as home builders and REITs.
You know, we were talking about the international markets earlier today. Before our show, our European colleagues, they had someone on from the IEA saying that the demand outlook was moving lower, and about half of those downgrades or declines were coming from the U.S. and China. What does that say to you about other markets outside the U.S.? Are they equally as attractive as they have been in the first half of the year, or do you see potential for a slowdown that would make the U.S. more attractive once again?
I think the U.S. is going to be the predominant market. It's going to be the most attractive market. One of the things that has driven those international markets, of course, is the decline of the dollar. I would not expect the dollar to decline as much going forward. So with the slowdown in worldwide growth and less decline in the dollar, I think you're going to see the U.S. prevail. And I think that growth in the U.S. is going to reaccelerate by the fourth quarter into 2026, which will make some of the cyclical sectors also more attractive.